we're a lot more strategic in terms of looking and working with institutional clients around correlation. And what we have provided them is, the insight into gold. So what you need to understand is that it's got long-term driving factors that will drive the price up. Market expansion, economic expansion, wealth creation. So that makes people rich and they spend. They buy consumable goods, they buy jewelry, and they save. It's got market risk and uncertainty, and it's the safe haven asset. So we tend to want to move them away from the short-term tactical factors that play in and make sure they have a balance of understanding the structure of gold and that long-term consumption, and that the drivers include central banks buying, institutional investors buying, then again consumers buying, and then also a technical use. So if you start understanding all of that, then you start working with them to understand the right kind of diversification. And we move them away from this short-term tactical understanding of correlation and say, look, understand the long-term trajectory of gold. So we've moved that dialogue into that place and actually provide correlation data mainly focused on bonds and equities, because that's usually where they're looking to diversify their portfolio away to actually find the right kind of long-term ballast in the portfolio. And we've moved the conversation from the 1 to 2% allocation into gold to about 4 to 5. Mm-hmm. And we've had big success with that on the institutional side, pension levels, institutional endowments and foundations particularly, as they've looked to put something more stable in the portfolio. Now there's definitely a lot of movement and activity on the short term in the gold market, but we're spending our energy looking at the kind of correlation you get. And if you look at equities, like just take the S&P 500 and you look at gold over the long term, what you're going to find is gold is positively correlated when the markets are growing and performing well, and it's got the right kind of negative correlation when the markets are dropping. So you got the right kind of correlation when you basically put gold into a portfolio. You get some of that with commodities, but gold performs better.